And here are the three things that you need to know this morning. First up, we talk about the latest with President Biden's trip to Europe. It has resulted in a new agreement for the U.S. to help the European Union reduce its reliance on Russian gas, which of course has been a big topic and sort of a big sticking point following Russia's invasion of Ukraine. The U.S. goal now is to provide at least 15 billion cubic meters more of liquefied natural gas to Europe over the course of this year, both from U.S. sources and maybe trying to cooperate and get it from other sources as well. To put it in perspective here, Russia accounts for about 40% of European gas consumption. However, the total here is 14 to 18 billion of cubic meters of liquefied natural gas and 150 billion of actual just gas versus pipelines coming into the European Union. So this U.S. agreement is still kind of a drop in the bucket here. But Biden and the EU President Ursula von der Leyen made the announcement. They had a joint presser, and now the details have to be worked out. And American shippers and German buyers are set to meet next week in Berlin in order to try to hammer out those details. We've been watching natural gas prices naturally in the wake of this. We've been watching crude oil prices as well. There's natural gas moving higher this morning by about 2.5%. The next stop for President Biden is said to be Poland. I believe he is set to arrive there this hour, in fact, as he continues to face the Russian invasion of Ukraine and discuss the prospects for that. And by the way, as we talk about all of this and the pain that Russia is feeling economically, even though it does not seem to be having an effect on the actual conflict, according to average of Bloomberg forecast, the Russian economy is forecast to enter a 2-year recession with 20% inflation this year, Saz.
And Julie, speaking of recessions here, good note, well, I wouldn't say necessarily good, interesting note by the team over at Goldman Sachs from their rates team. They are lifting their 10-year Treasury outlook for this year to 2.7% from 2.25%. Previously, they're calling out that this reflects more broad-based and persistent price pressures and an accompanying hawkish Federal Reserve pivot, or essentially in layman's terms, that the Fed perhaps moves quicker on interest rate hikes than the market expects here. But again, very actually a great thing to hear if you are bullish. I think stocks more broadly, tech stocks here. And of course, you have to think about, Julie, what does something like this, if this happens, this move in 10-year treasuries, what does it mean for consumer spending? What does it mean to housing and buying a home in this country?
Yeah, and we're going to talk about all of that throughout the course of the next 2 hours, and I'm sure in the coming days as well, as we continue to watch the yield curve narrow here and flatten, which is something that has caused a lot of alarm for folks.